Indian stock market benchmarks, which is the Nifty and Sensex, soared to record high levels today on the back of three main factors: exit polls, GDP data, followed by positive global cues. Let's jump in and discuss this. Before we start, let's see how our benchmarks are performing today. If you can see the chart on the screen, the Nifty 50 as well as the Sensex both have soared to record highs, witnessing an impressive 3% gain on a single day. In fact, the market witnessed broad buying throughout all sectors, led by the banking sector, financial services, metal and realty sectors. So anyway, back to the story. Let's discuss these three factors in detail. Firstly, the exit poll results. Basically, exit polls are surveys conducted immediately after voters have exited polling stations. These polls aim to predict the outcome of elections by asking voters who they voted for, giving us an insight of the result. And guess what? Recent exit polls predicted a landslide victory for the NDA or National Democratic Alliance government, which is led by the BJP, which is expected to win over 350 seats out of the 543 seats in the Lok Sabha elections 2024. In fact, three major exit polls, News 24, India Today and India TV CNX, have predicted 400 plus seats for the NDA. On the other hand, the pollsters have predicted less than 200 seats for the opposition INDIA bloc. These exit polls have instilled confidence in investors who believe policy continuity and stability are crucial for economic growth. A stable government often translates to predictable policies, which allows businesses to plan for the future with greater certainty. This in turn fosters investments and fuels market growth. Another factor is robust GDP data. Adding to the positive sentiment was the release of strong GDP data for the previous quarter. India's GDP for the fourth quarter of fiscal 24 grew by 7.8% year-on-year, up from 6.2% in the same period last year. This growth exceeded analysts' expectations, which were below 7%, but was a decrease from the 8.6% growth seen in the previous quarter. Further, the center now estimates the overall growth rate of fiscal year 24 to be 8.2% as per MOSPI. But when we look at the finer details, gross fixed capital formation, which is spending by the central government, has seen a considerable rise over the quarters and witnessed a growth of 6.5%. This means government policies aimed at boosting economic growth, such as infrastructure, spending, tax incentive, etc., have contributed to economic expansion. Even the private consumption expenditure recorded a muted growth of 4%, reflecting weaknesses. Exports, on the other hand, registered strong growth of 8.3%, while imports decreased during the quarter to 8.3%. When looked at the sector-wise contributions, the manufacturing sector recorded an impressive growth of 8.9%, while the construction grew at 8.7%, both contributing significantly to the overall GDP growth in the fourth quarter. However, agriculture sector growth was a significant laggard, contributing a mere 0.6% year-on-year in quarter 4, which employs over 46% of the entire population. This data served as a validation of India's economic resilience and its potential for future growth. In fact, the World Bank and IMF have also stated that despite global challenges, India's growth remains resilient. India is expected to remain the fastest growing major economy, showing resilience against geopolitical challenges and supply chain disruptions. Lastly, the Indian markets also benefited from supportive global cues. Major international indices were trading in the green, buoyed by optimism surrounding a potential slowdown in interest rate hikes by the US Federal Reserve and ECB. In fact, Morgan Stanley expects an interest rate cut starting in September. A dovish stance from the Fed can lead to increased liquidity in the global financial system, which can find its way into emerging markets like India. This positive sentiment from around the world further amplified the bullish mood in the domestic market. All in all, the confluence of these three factors, exit polls, strong GDP data, and supportive global cues, created a perfect storm for the Indian stock market. Investors filled with optimism are flocking to equities, pushing Sensex and Nifty to unprecedented highs. However, it's crucial to remember that stock markets are inherently volatile and corrections are inevitable. While the current sentiment is positive, long-term investors should maintain a balanced portfolio and a disciplined investment strategy. Having said that, this is me, Rahul Hassan, signing off. Have a great day and stay safe.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.